Let's continue with the ratio analysis. Okay, financial management ratio analysis. So let me read the question first. So 2014 paper, answer the question. So gross profit is equal to 1,08,000. Shared offense is equal to 6 lakhs. Gross profit margin ratio 25%. What is GP ratio? Ma? GP ratio is equal to GP by sales. GP by sales. That is equal to 25%. So credit sale by total sale ratio 80%. Out of total sale, 80% is going to be credit sale. Balance 20% is going to be cash sales. So total turnover to total assets is going to be 0.3 times. Closing stock to total sales 1 by 5 times. 1 by 5 times. Average data is going to be 20 days. 20 days, every 20 days we are getting payment from the debtors. Current ratio 1.5. Long-term debt to equity 80%. So consider 1 is equal to 360 days. And there are 6 questions you have to answer. First question, fixed asset turnover ratio. Second one, cash and bank balances. Third one, current liability. The fourth one, closing stock you have to find out. The fifth one, closing debtors. And last one, cash sales. So once the closing credit sales is known, automatically balance is equal to cash sales. That we come to know. Okay. First, my first target, I'm going to solve gross profit and GP margin. I'm telling you one more fact, ma. So by solving the problem only, you come to know which one you have to take first. Because there is a pure logic, nothing available. Okay, I know the formula, then I know the logic. First, I have to select GP and GP ratio. Working capital current ratio is given, that you have to choose. Or GP ratio and GP is given, that you have to take. Logically, you have to take first. Okay, right, that's it. Anyway, we're going to use all the ratios. First, my priority, GP and GP margin. Let me start with that. First one, GP. Oh, what is GP ratio? GP by sales, correct? No, fine. Gross profit by sales. What is GP ratio? It's going to be 25%. It's going to be 25%. 25%. Oh, what is GP, ma? 1,08,000. 1,08,000 GP. So 1,08,000 GP by sale, that is equivalent to 25%. So sale is equivalent to, can you make the sale here, ma? That's it. So 1,08,000 by 25%. By 25%. Can you do the mathematical calculation, ma? Okay, ma. 1,08,000 by 25%. That is equal to 4,32,000. So sales is equal to 4,32,000. Now that is equivalent to sales. 1,08,000 by 25%. 4,32,000 is going to be sales. Out of sales, one is cash sales. Another one credit sales. Another one credit sales. Let me start with this is total sales. Let's go with 80% total sales is equal to credit sales. See the line, fourth line. Credit sale by total sale equal to 80%. Credit sale by total sale equal to 80%. Which means out of total sale, credit sale 80%. Credit sale 80%. Now then balance 20% cash sales. Cash sales. So 4,30,000 into 80%. Answer, ma? 3,45,600. That is credit sale. That is credit sale. Credit sale. That's it. So balance 20% cash sales. So 4,30,000 minus 3,45,600. Answer 86,400 cash sales. That's it. So what if last question cash sales they're asking you, correct? No. You have to fill one by one all the values. Last one cash sales. Cash sales. What is cash sales? 86,400. So cash sales is equivalent to 86,400. That's it. That's it. Next, once the credit sales are known, automatically we can find debtors also. We can find debtors also because I know exactly. Every collection period I know that is 360 days. 1 year is equal to 360 days. Every debtor collection I know that is 20 days. 20 days. Credit sales I know automatically I can find debtors. Okay. Is there any shortcut to find debtor? Yes. Yes. This is the shortcut I told you earlier. Please memorize. Debtor is equivalent to credit sale into average collection period in terms of days. Please memorize, ma. Please memorize. Average collection period in terms of days. By 360. Average collection period in terms of days by 360. That's it. So credit sales already I know that is going to be 3,45,600. Average collection period is equivalent to 20 days. Average collection period is equivalent to 20 days. 1 year is equal to 360 days. 1 year is equivalent to 360 days. So 360 days credit sales I know, but I want data for 20 days only. So 3,45,600 into 20 days average collection period. Please check 20 days average collection period by 360 by 360. That's it. So 340 by 600, 340 600 into 20 by 360. It is going to be 19,200. 19,200. Now that is going to be data. That is going to be data. So 19,200 is equal to data. Please check it out. 19,200 is going to be data. So please fill data is equal to 19,200. That's it. Now only logic, no magic, only logic. Now data is equal to 19,200. That's it. Next, we have to find these values. Correct? No? Fine. Next one, shareholder funds given. Correct? Then total turnover by total assets. Can I use this ratio? Yes. Total asset by total turnover by total assets 0.3 times. 0.3 times. Okay. So total asset, total turnover, numerator, denominator, total assets. So total turnover by total assets, So total turnover by total asset, that is equivalent to 0.3 times. 0.3 times. 0.3 times. So total turnover by total asset 0.3 times. 0.3 times. What is total turnover? 4,32,000. What is total turnover? 4,32,000. That's it. A total turnover 4,32,000. 4,32,000 by total asset question mark. Total asset is going to be question mark. Correct? No? That's it. It is going to be 0.3. 0.3. So 4,32,000. 4,32,000 total turnover by total assets. Total turnover is going to be 4,32,000 by total assets. That's it. That is equal to 0.3. Please check it out. That's going to be 0.3. 0.3. Please check 0.3. Right. Okay. So please make it sure. Total assets 4,32,000 by 0.3. By 0.3. By 0.3. By 0.3. And it's going to be 14,40,000. Correct? Please check it out. 14,40,000. So 4,32,000 by 0.3. That is equal to 14,40,000. It is going to be total assets. 14,40,000 is going to be total assets. So total assets I know. Total assets I know. Correct? No? Fine. Okay. Let it be total assets is it. Right. Next one. Next to my target, I'm going to use one by one all the ratios. All the ratios. Then closing stock by total sales. That is equal to 1 by 5 times. Closing stock by total sales 1 by 5 times. Now let me start with that. Closing stock by total sales 1 by 5. So closing stock by 1 by total sales. Closing stock by 1 by total sales. Closing stock by total sales. That is equal to 1 by 5. Please check it out. Closing stock by total sales. So closing stock by total sales, that is equal to 1 by 5. Okay. So total sales 4,32,000. 4,32,000. So total sale 4,32,000. Please check it out. Total sale 4,32,000. Here is going to be closing stock. Now only logic, that's it. So 4,30,000 closing stock numerator. It's going to be 1 by 5. 1 by 5. Please check. So closing stock is equal to 4,32,000 into 1 by 5. Into 1 by 5. So 4,32,000 by 5 by 5. It's going to be 86,400. Now that is equivalent to closing stock. That is equivalent to closing stock. So closing stock 86,400. Please check it out. 86,400. So 4,32,000 by 5, 86,400. So closing stock 86,400. 86,400. Please check it out. That's it. Okay. Next one, current liability. Next one, current liability. Okay. Okay. Next one. Okay. Okay. Next one. We'll go with this one. Long-term debt by equity 80%. Long-term by equity 80%. Long-term debt. That means long-term borrowings. Debenture, loans. Okay. Long-term debt. Now please check your long-term debt by equity. Long-term debt by equity. Long-term debt by equity that is equivalent to 80%. So long-term debt by equity. Long-term debt by equity. Long debt by equity that is equal to 80%. 80%. Okay. Sorry. Okay. What is shareholder long-term equity? Equity is equal to shareholder funds. Shareholder funds is nothing but equity. Equity. How much equity? 6 lakhs. 6 lakhs. Equity 6 lakhs. So equity 6 lakhs. That is equal to 80%. 80%. Now this is going to be long-term debt by equity 80%. So long-term debt that is equivalent to 6 lakh into 80%. 6 lakh into 80%. It's going to be 4 lakh. Please check it out. Fine. 4 lakh 80,000 long-term debt. Long-term debt is going to be 4 lakh 80,000. 4 lakh 80,000. Right. Now, rough balance sheet. Liability asset. The shareholders funds. Shareholders funds. Then it's going to be 6 lakhs. Long-term debt 4 lakh 80,000. Rough balance sheet. Rough balance sheet. So balance figure. So current liability. Balance figure. Current liability that is equivalent to liability side. Asset side. Fixed asset. Then current asset. So current asset consists of stock, closing inventory, debtors, cash in and or cash at bank, balance sheet figure. Then is equivalent to total assets. That's it. Okay. Already we know total asset. What is total asset value? 14 lakh 40,000. 40 lakh 40,000. So 14 lakh 40,000 total assets. What is stock value? 86,400. What is stock value? 86,400. Stock value. Okay. Next. What is debtors value? 19,200. Debtors value 19,200. Okay. What is total asset? 40 lakh 40,000. Then what is total liability? 40 lakh 40,000. What is total asset? 40 lakh 40,000. What is total liability? 40 lakh 40,000. Clear? That's it. Now balance sheet figure. Current liability. So 14 lakh 40,000 minus 6 lakhs minus 4 lakh 80,000. Answer 3 lakh 60,000. So 3 lakh 60,000. It's going to be that's it. Balance sheet figure 3 lakh 60,000. Okay, this is current liability. Okay, let me solve a current ratio. Current ratio you have to find. So current ratio is equal to current asset will be current liability. That is equal to 1.5. 1.5. 1.5. So my current ratio that is equivalent to current asset by current liability. So current asset will be current liability. That is equivalent to current asset by current liability. Current liability. So current ratio is going to be 1.5. Current ratio is going to be 1.5. Current ratio is going to be 1.5. So already you know current liability. What is current liability? What is current liability? 3,60,000. So 3,60,000 current liability. So current asset numerator that is equal to 1.5. So current asset is equivalent to 3,60,000 into 1.5 into 1.5. Logically, you have to solve 3,60,000 into 1.5. It's going to be 5,40,000. So current asset 5,40,000. Substitute current asset here. This is current asset total. What is current asset total? 5,40,000. So current asset total 5,40,000. 5,40,000 minus stock. 86,400. Minus data is 19,200. My balance is 4,35,400. It is going to be cash in hand. Please check it out. 4,34,400 cash in hand. So cash in hand is equal to 4,34,400. So cash in hand is equal to 4,34,400 cash in hand. Current liability is equal to 3,60,000. So current liability is equal to 3,60,000. So current liability is equal to 3,60,000. 4,34,400 is going to be cash in hand. 3,60,000 current liability, right? So I use almost all ratios except fixed asset turnover ratio. We have to find out. Correct now? Fixed asset turnover ratio we have to find out, right? So out of 14,40,000, 5,40,000 current asset. Balance figure, fixed asset. Now balance figure, fixed asset. Out of 14,40,000, minus 5,40,000, balance figure 9 lakhs. 9 lakhs going to be fixed asset. And 9 lakhs going to be fixed asset. That's it, fixed asset. Out of 14,40,000, current asset 5,40,000, balance 9 lakhs. Balance 9 lakhs. That's it. But this is fixed asset. 9 lakhs. 14,40,000 minus 5,40,000, 9 lakhs fixed asset. So 9 lakh fixed asset, right? Now the question is fixed asset turnover ratio, correct? No, fixed asset turnover ratio, right? So how to find fixed asset turnover ratio? I told you any turnover is always numerator. The term before turnover is always denominator. Suppose fixed asset turnover means turnover numerator, which means sales numerator. Fixed asset denominator. Any asset turnover ratio, turnover numerator, the word before turnover is going to be denominator. That's it. That's the logic you have to apply. So sales by fixed asset. Fixed asset turnover ratio, sales by fixed asset. Sales by fixed asset. Now what is sales actually? What is sales actually? Sales 4,32,000. Sales 4,32,000. Sales 4,32,000. So sales 4,32,000 sales. What is fixed asset? 9 lakhs. 9 lakhs. 9 lakhs. 9 lakhs. Now 4,32,000 by 9 lakhs. Please check it out. 4,30,000 by 9 lakhs. By 9 lakhs. It's going to be 0.48. 0.48. What is any asset turnover ratio formula? Any asset turnover ratio, turnover numerator, left hand side to the turnover, I mean anything before turnover, the word no. Fixed asset means fixed asset denominator. Current asset means current asset denominator. Working capital means working capital denominator. Any turnover ratio, turnover always numerator. The word before turnover is always denominator. That's our logic. Okay, so anyway, 0.48 is going to be Out of 9 lakhs, sales is 4 lakh 32. This company doing poor sales. So investment in for extra asset 9 lakhs. Sales going to be 1 lakh 4 lakh 32. 0.48. That's it. So they are having poor fixed turn ratio. If they are not using the asset properly. Conclusion. They are not using the asset properly. So fixed turn ratio is equal to 0.48. Anything above 1 is okay. To certain extent, okay. 1 time, 3 time, 4 time, 5 time, always better. Even not even 0.5, less than 0.5, which means 9 lakhs invested in fixed asset. The sales is only 4 lakh 32. The company not focusing on sales, not focusing on sales. That's it. That's the logic. That's it. Anyway, the question we found everything. That's it. It's going to be 8 marks. Let's start the 2015 paper. Determine which company is more profitable, A limited or B limited. Net profit ratio for A limited 5%, B limited 8%. Turnover ratio for A limited 6 times, B limited 3 times. Which is more profitable? Which is more profitable? That's it. Okay, fine. Which is more profitable, right? So let's start with the okay. Net profit ratio is no, and 6 times. Okay. First, before you proceed, you know what you mean by DuPont chart. DuPont chart. DuPont is American engineering company. So in the name of DuPont, so we established some relationship between return on equity, net profit ratio, asset turnover ratio, and equity multiplier. Now this is DuPont model. DuPont model. DuPont is American engineering company. Here we can find return on equity. What is ROE? Return on equity. To find ROE, we have to do net profit margin. Net profit by sales into asset turnover ratio. Sales by asset. Sales by asset into equity multiplier. Equity multiplier. Asset by equity funds. Asset by equity funds. That's it. But this is called ROE formula. How is it ROE? Or what is ROE? Out of equity funds, what is net profit? Sales cut. Correct? Asset cut. Correct? Please check it. Sales cut. Asset cut. Please check. Net profit by equity funds, ROE. That's it. Out of investment, what is the net profit? That's called ROE. This is called net profit margin. This is called net profit margin. This is called asset turnover ratio. This is called asset turnover ratio. This is called equity multiplier. This is called equity multiplier. Equity multiplier. That's it. Equity multiplier. So net profit margin, asset turnover ratio, equity multiplier. So this is, if you combining all the three, if you multiply all the three, the result will be return on equity. Net profit by sales, sales by asset, asset by equity fund. Asset by equity fund is equal to equity multiplier. Out of equity means what is your asset? Asset ratio, sales by asset. Sales cut, asset cut, net profit equity fund. That's it. Here, net profit margin ratio is given. That is equal to 5%. Asset turnover ratio is given. That is equal to 6 times. 6 times. This is not given, no issues. Not given, no issues. Okay. Any out of assets, what is net profit? That's it. Automatically it's going to be 30%. 30% ROE for A limited company. Similarly for B limited, ROE is equal to net profit margin ratio 8%, turnover ratio 3 times. But here equity multiple not given, don't worry. Even not given, simply multiple and tell which is more benefit. Which is more benefit of the company. B limited 8 into 3, so 25%. Where is ROE is higher, Company A. Where is ROE here? Company A. That's it. So ROE will be more for company A. Therefore, which company more profitable? A limited is more profitable because their ROE 30%. How much return they giving to equity holders? 30%. Out of 100 rupees, equity holders invested, 30% they getting return. So a A limited having more profitable one. A limited having more profitable one. That's it. That's the answer. A limited more profitable one. That's it. This equation is called DuPont model. To find ROE, please memorize. Net profit margin into asset turnover ratio into equity multiplier. That's it. Okay. Now let's start with the 2015 paper. The following information available as on 31/3/15. Current ratio 2.37:1. Current liability net worth 20%. Total debt to net worth 39%. What is current ratio? Current asset by current liability. So debt by net worth 39%. Fixed asset by net worth 85%. Sales by net worth 2.4 times. Inventory to current assets 1:3. Average collection period from the debtor, every 1 month we are getting payment from a debtor asset. Working capital 5,10,000. Whenever current ratio and working capital given, please connect these two first. Please connect these two first. What is current ratio? Current asset by current liability. What is working capital? Current asset minus current liability. Please connect these two first. Then rest of the question automatically will follow. So the question they are asking you. So calculate as on 31/3/50 fixed asset, inventory, debtors, cash and bank combined figure, net worth, that is shareholders fund, long-term debt, current liability, total asset. Okay, there are 8 questions they are asking. I told you current ratio and working capital to be resolved first. That's it. Now start with current ratio. Current asset by current liability. Working capital is equal to current asset minus current liability. What is current ratio, ma? 2.7:1. 2.7:1. That's it. 2.7:1. That's it. That's it. What is working capital? 5,10,000. 5,10,000. Working capital is equivalent to 5,10,000. Working capital is equivalent to 5,10,000. That's it. Working capital 5,10,000. That's it. So current asset that is equivalent to 2.7 into current liability. Please cross multiply, 2.7 to current liability. What is current asset, ma? 2.7 to current liability. Can you substitute here? Can you substitute here? Yes. What is current asset? What is current asset? 2.7 into current liability minus 1 current liability. That is equivalent to 5,10,000. That's it. What is current asset, ma? 2.7 current liability minus 1 CL is equal to 5,10,000. 2.7 CL minus 1 CL, 1.7 CL. That is equivalent to 5,10,000. So current liability is equivalent to 5,10,000 by 1.7. Answer, ma? 5,10,000 1.7. 5,10,000 by 1.7. 1.7. It's going to be 3 lakhs, I think. Please check it out. Please check it out. 3 lakhs, I think. So 5,10,000 by 1.7 is going to be 3 lakhs. Please substitute 2.7 into current liability. What is current liability here? 3 lakhs. Can you substitute here 3 lakhs? Yes. Can you substitute 3 lakhs here? Yes. So 2.7 into 3 lakhs. That is equivalent to 8,10,000. 8,10,000. That is equivalent to current asset. Current asset. That's it. So current asset equal to 8,10,000. That's it. So that's it. Okay. Anyway, current liability is known. What is current liability? 3 lakhs. So current liability is known 3 lakhs. 3 lakhs. So current liability 3 lakhs. Okay. Next one by one slowly we'll do. I know current asset, I know current liability. Correct? No, that's it. Okay. Next one. I'm going to use this one. Current liability by net worth. That is equal to 20%. That is equal to 20%. So current liability by net worth. Net worth. So current liability net worth is equivalent to 20%. So current liability by net worth is equal to 20%. Now current liability is going to be 3 lakhs. By net worth equal 20%. Net worth is equivalent to 3 lakhs by 20%. 3 lakhs by 20%. That is equivalent to 15 lakhs. 15 lakhs. That is equivalent to net worth. Net worth. So 3 lakhs by 20%, that is equal to net worth. My net worth is going to be 15 lakhs. 20 lakhs. The question is net worth also. Net worth, please check it out. 15 lakhs. Net worth is going to be 15 lakhs. 15 lakhs. Next one. One by one we draw slowly. Here, total debt by net worth, that is equal to 39%. So total debt by net worth. So total debt by net worth by net worth. So total debt by net worth is equal to 39%. So 39%. So total debt by net worth is equal to 39%. Net worth 15 lakhs. Net worth 15 lakhs. Net worth 15 lakhs. So total debt by net worth 15 lakhs. So total debt question mark. Question mark. Can you cross multiply, ma? So total debt is equivalent to 15 lakhs, ma, into 39%. 39%. Answer, ma? 5 lakh 85,000. That's it. 5 lakh 85,000 total debt. That's it. Yes. 5 lakh 85,000 total debt. So this total debt can be resolved into so 5 lakh 85,000. So can be resolved into long term debt and current debt. Long term debt and current debt. Current debt is nothing but current liability. My current debt is nothing but current liability. What is current liability here? What is current liability? Ma? 3 lakhs. 3 lakhs. Current liability 3 lakhs. Please check your current liability 3 lakhs. The long term debt balance sheet figure 2 lakh 85,000. 2 lakh 85,000. That's it. So current debt is 3 lakhs. Out of 5 lakh 80,000, current debt is 3 lakhs. Balance long term debt. That is going to be 2 lakh 85,000. So please check it out here. What is long term debt here? 2 lakh 85,000. Balance sheet figure. So current debt means current liability. That is already known. So current debt means current liability. Current liability is already known. Already known. So balance figure 2 lakh is long term debt. Long term debt. So long term debt is going to be 2 lakh 85,000. 2 lakh 85,000 long term debt. That's it. So that is also known one by one slowly, right? Next one. Can I go with fixed asset, ma? Fixed net worth, how much? 85%. That is also known. Correct? No, that is also known. Please go with the fixed asset by net worth. Fixed asset by net worth that is equivalent to 85%. Fixed asset by net worth that is equal to 85%. What is net worth? 15 lakhs. 15 lakhs. Net worth 15 lakhs. 15 lakhs. So fixed asset missing. That is equivalent to 85%. Fixed asset by net worth 85%. Can you cross multiply, ma? That's it. $15 lakhs into 85%. 12 lakhs 75,000. That's it. So 15 lakh into 85%. Can you cross multiply, ma? Please cross multiply. Please cross multiply. So fixed asset is equivalent to 15 lakhs into 85%. That is equivalent to 12 lakh 75,000. That's it. So fixed asset 12 lakh 75,000. 12 lakh 75,000. That's it. Next one, inventory. Inventory to current asset we can apply. Inventory to current asset we can anything. See, everything you have to make it tick. All the ratio to be applied finally. Inventory to current asset 1 by 3. 1 by 3. Next one. Inventory by current asset. Inventory by current assets. That is equivalent to 1 by 3. Inventory by current asset 1 by 3. Inventory by current asset 1 by 3. That's it. Okay. Now, already we know current asset, I think. Please check it out. Already we know current asset. 8,10,000. Please check it out. Already we know current asset. There is 8,10,000. 8,10,000. 8,10,000. So please substitute current asset here. Inventory 8,10,000 here. That is equivalent to 1 by 3. That is equal to 1 by 3. Can you multiply 8,10,000 into 1 by 3? That's it. So 8,10,000 into 1 by 3. Please multiply. That's it. So 8,10,000 by 3 by 3. It's going to be 2,70,000. No, 2,70,000. Inventory 2,70,000. Please check it out. 2,70,000 inventory. Inventory 2,70,000. Inventory 2,70,000. That's it. Okay. Finally, we did. Okay. Inventory 2,70,000. Perfect. Next ratio, sales to net worth 2.4 times. So I can find sales. Sales by net worth. It's going to be sales by net worth. It's going to be 2.4 times. 2.4 times. Sales by net worth 2.4 times. Net worth 15 lakhs. Net worth 15 lakhs. Sales by net worth 15 lakhs. Sales by net worth 15 lakhs. That is equal to 2.4. Sales 15 lakhs into 2.4 into 2.4. It's going to be how much more? Into 2.4. 36 lakhs. So sales 36 lakhs. Sales going to be 36 lakhs. Okay. Sales 36 lakhs. Is it cash sales or credit sales? Nothing is given. Correct? No. Maybe credit sales. Total sales cash. Both are same. Is there any cash sales differentiation? No. No. So you can assume this is equal to either total sales or credit sales. Both are same because there is no cash sales. Correct? No. There is no cash sales differentiation. Therefore, either you can treat either total sales or credit sales. 36 lakhs. Next. Average collection period is given. Yes, we can apply. Average collection period is given. Yes, you can apply. How many months? 1 month. 1 month. Once credit sales and the IACP is known, you can find debtor also. Debtor also. Debtor is equal to credit sale into average collection period in terms of month by 12 months. So credit sale 36 lakhs. Average collection period is going to be 1 month. 1 month. Average collection period is going to be 1 month. So 1 month by 12. 1 month by 12. That's it. By 12. So 36 lakhs by 12. That is equivalent to 3 lakhs. That is equivalent to 3 lakhs. So debtor is equivalent to 3 lakhs. Debtor is equal to 3 lakhs. 3 lakhs. Debtor is equal to 3 lakhs. 3 lakhs. Okay. Whether we use everything? Yes, everything we used, right? So can you draw rough balance sheet for sake of understanding? Rough balance sheet for sake of understanding, so that missing figure can be identified. So liability, net worth, shareholder funds, then long-term debt is also there. Yes, long-term total debt is there. Long-term debt also there. Long-term debt is there. Then current liability is there. So current liability is there. Here it's going to be fixed asset. Here is going to be, so current asset, current asset consists of inventory, debtors, cash and bank. Debtors, cash and bank, cash and bank. That's it. Inventory, debtors, cash and bank. That's it. That's it. Inventory, debtors, cash and bank. That's it. Okay, done. Done away with that. Okay. Inventory, 2,70,000. Inventory, 2,70,000. Debtors, 3 lakhs. 3 lakhs. Net worth 15 lakhs. Long-term debt 2,85,000. Long-term debt 2,85,000. 2,85,000. Current liability 3 lakhs. So net worth 15 lakhs. Long-term debt 2,85,000. Current liability 3 lakhs. 3 lakhs. Fixed asset 12,75,000. 12,75,000 fixed asset. Fixed asset 12,75,000. That's it. Okay, current asset total. Please check current asset. That's it. Current asset total 8,10,000. 8,10,000 current asset total. 8,10,000. Okay. 8,10,000 current asset total. Okay. So total asset 8,10,000 plus 12,75,000. That's it. So it's going to be 20,85,000. So 12,75,000 plus 8,10,000. So 20,85,000. Now please check it out here. 20,85,000. Has it got tallied now? 15 lakhs plus 2,85,000 plus 3 lakhs is 20,85,000. Out of 8,10,000, inventory sector if you subtracting from current asset, balance figure cash and bank. Yes, ma'am. So 8,10,000 minus 2,70,000 minus 3 lakhs is going to be 2,40,000. So cash and bank is 2,40,000. That's it. That's it. So remaining value you have to fix. Correct? Right. So cash and bank balance B 2,40,000 D total asset total is going to be 20 lakh. 20,85,000 20,85,000. So total asset 20,85,000. So total asset 20,85,000. That's it. Is everything is known? All the ratios we used. That's it. I'll start 15 paper. Current ratio 2.4 is to 1. Working capital 20. I told you already, whenever current ratio working capital, preference will be always given to these two. You find current asset and current liability. That's it. So current ratio is going to be current asset by current liability, and that is equivalent to 2.4 by 1. Working capital is equal to current asset by current liability, that is equivalent to 25,20,000. So what is current asset here? Can you cross multiply? Can you cross multiply? 2.4 into CL. What is current asset here? 2.4 CL. 2.4 CL. So current asset equal to 2.4 CL minus CL, that is equal to 25,20,000. That's it. That's it. So current asset 2.4 CL. 2.4 CL. Current liability 1 CL. 1 CL. 25,20,000. That's it. 2.4 CL minus 1 CL. 1.4 CL. That is equal to 25,20,000. That's it. That's it. .4 CL minus 1 CL, 1.4 CL. That's it. So CL is equivalent to 25,20,000 by 1.4. So 25,20,000 by 1.4. So 25,20,000 by 1.4. How much more? 80 lakhs. So current liability 18 lakhs. So current asset is equivalent to 2.4 into current liability. That is 18 lakhs. So current liability is equal to 18 lakhs. 18 lakhs into 2.4. 18 lakhs into 2.4. Answer no? 43,20,000. Correct no? 2.4 into 18 lakhs. 43,20,000. That's it. Now this is going to be current asset. So 40,20,000 is going to be current asset. That's it. That's it. So 40,20,000 current asset. So question is current asset, current liability. That's it. Let's start next one now. Choose the 15 paper. The following accounting information, financial ratios of Bowler Limited related to the year ended 31/3/2015 is given. Inventory turnover ratio based on COGS 6 times. What is inventory ratio? COGS by average stock. COGS by average stock. So credit turnover ratio, credit purchase by average payment period. What is debtor turnover ratio? Credit sales by average account receivables. What is current ratio? Current asset by current liability 2.4. What is GB ratio? GB by sales 25%. Total sales is given 60 lakhs. Cash sales is equal to 25% of credit sales. Some information given. Cash purchase given 4,60,000. Working capital, that is current asset minus current liability 7,14,000. Closing stock 1,03,000 more than the opening stock. We are required to calculate average stock, purchases, average debtors, average creditors, average payment period, average collection period, current asset, current liability. That's it. Let's start with my first priority always current ratio and working capital. That's it. Always. Because so that's information very clearly given. First you solve these two. So current ratio. Current asset by current liability. That is equivalent to 2.4. 2.4. Working capital is equivalent to current asset minus current liability. That's it. So current asset minus current liability is equal to 7,14,000. 7,14,000. Working capital, current asset minus current liability, 7,14,000. That's it. That's it. 7,14,000. So current asset is equivalent to 2.4 times the current liability. Here the current asset is equivalent to 2.4 the current liability minus 1 current liability, that is equivalent to 7,14,000. That's it. 2.4 CL minus 1 CL, 1.4 CL. That is equivalent to 7,14,000. So current liability is equivalent to 7,14,000 by 1.4 by 1.4. Okay, ma'am. 7,14,000 by 1.4. It's going to be 5,10,000. So current liability 5,10,000. So current asset, current liability we can fill. Current liability 5,10,000. Current asset you have to fill. So current liability 5,10,000. Can you substitute here to get current asset? Current asset equal to 2.4 into current liability. 5,10,000 into 2.4. It's going to be 12,24,000. It's going to be 12,24,000. So 12,24,000. That's it. It's going to be 12,24,000. Is current asset. 12,24,000 current assets. 12,24,000. So 12,24,000 current assets. 12,24,000 current assets. Right. Next, we'll solve one by one. Okay. Next, my target is on GP ratio and the total sales. It's my target on GP ratio and total sales. Even credit sale credit sales also can take. Okay. But anyway, you have to use everything. GP ratio 25%. 25%. Total sale 60 lakhs. 60 lakhs. GP by total sale 60 lakhs. That is equivalent to 25%. 25%. So GP is equivalent to 60 lakhs into 25%. That is equivalent to 15 lakhs. 15 lakhs. GP equal to 15 lakhs. But next we find cost of goods sold, COGS. Cost of goods sold. You know, that is very much required for inventory ratio. Inventory ratio. So cost of goods sold, that is equivalent to sale minus gross profit. So sale minus gross profit, that is equal to cost of goods sold. Sale 60 lakhs. Gross profit 15 lakhs. 60 minus 15, 45 lakhs. That is going to be cost of goods sold. The cost of goods sold 45 lakhs. 45 lakhs. Once cost of goods sold known, we can use inventory turnover ratio. We can use inventory turnover ratio. Inventory turnover ratio is nothing but cost of goods sold, COGS. Cost of goods sold, COGS by average stock. So here inventory turnover ratio is equal to 6 times based on COGS. See the first line? Inventory ratio is going to be 6 times. 6 times. 6 times. 6 times. So inventory ratio 6 times. That's it. What is COGS? 45 lakhs. COGS 45 lakhs. 45 lakhs by average stock. That is equivalent to 6 times. So average stock is equivalent to 45 lakhs by 6. Okay. 45 lakhs by 6. 7,50,000. So average stock. Actually, generally average stock is a denominator, not closing stock, average stock. If average stock is not there, now we can take closing stock. Okay. So 7,50,000 is going to be average stock. Average stock. Okay. Next to close. What is average stock actually? Opening stock plus closing stock by 2. By 2. Average stock is equal to opening stock plus closing stock by 2. By 2. Opening stock plus closing stock by 2. And that is equivalent to 7,50,000. 7,50,000. That's it. That's equivalent to 7,50,000. Right. Now, there is a clue here. See a point. Closing stock 1,60,000 more than opening stock. Correct now? Right. Closing stock is equal to 1,60,000 more than opening stock. Closing stock is equal to opening stock plus 1,60,000. Opening stock plus 1,60,000. Closing stock is opening stock plus 1,60,000. That's it. That's a clue. That's a clue. That's a clue. Okay. Now opening stock as usual. Can I replace the closing stock by? Can I replace the closing stock by opening stock plus 1,60,000? We can replace. We can replace closing stock by. I can replace the closing stock by opening stock plus 1,60,000. So opening stock plus 1,60,000. I'm replacing closing stock by opening stock plus 1,60,000 by 2. By 2. That is equivalent to 7,50,000. That's it. That is equivalent to 7,50,000. That's it. Opening stock plus opening stock. So 2 times of opening stock plus say 1,60,000. Opening stock plus opening stock 2 times opening stock plus 1,60,000 by 2. That is equivalent to 7,50,000. 2 opening stock plus 1,60,000 by 2 is equal to 7,50,000. So 2 into opening stock plus 1,60,000. Can you cross multiply? 2 into 7,50,000. 2 into 7,50,000. So 2 into opening stock is equal to 2 into 7,50,000, 15 lakhs minus 1,60,000 to right hand side. Please bring right hand side. 2 into 7,50,000, 15 lakhs minus 1,60,000. 15 lakhs minus 1,60,000. It's going to be 13,40,000. 15 lakhs minus 1,60,000, 13,40,000 is equivalent to 2 into opening stock. 13,40,000 is equivalent to 2 into opening stock. Opening stock is equivalent to 13,40,000 by 2. So 13,40,000 by 2. By 2. That's it. 13,40,000. Okay, by 2. By 2. It's going to be 6,70,000. It's going to be 6,70,000. That's it. So this is opening stock. 6,70,000 is the opening stock. And what about closing stock? Closing stock is equivalent to closing stock is equivalent to opening stock plus 1,60,000. Please check. Closing stock equal opening stock plus 1,60,000. So closing stock is equal to opening stock plus 1,60,000 plus 1,60,000. That's it. What is opening stock? 6,70,000 plus 1,60,000. Answer 8,30,000. That's it. 8,30,000. Now this is going to be closing stock. This is going to be closing stock. 8,30,000. 8,30,000 closing stock. That's it. 8,30,000 closing stock. So closing stock is known. That's it. Okay, right. Let it be. Okay, let's start with one by one all the question. So far, average stock is known. Average stock is known. What is average stock? Please check it. Average stock is equivalent to 7,50,000. 7,30,000 average stock. Average stock 7,50,000. 7,50,000 average stock. 7,50,000 average stock. That's it. Okay. Next one. Opening stock, closing stock also no. Correct. No. That's it. Okay. Next, my target on data turnover ratio. Data turnover ratio. My target data turnover ratio. That's it. I know credit sales also. Sorry, credit sales also unknown so far. Credit sales we found not yet no. Right. For total sales only given. Correct no. Right. Next to my target on. So okay, just wait. First I segregate what is cash sales, credit sales. Next we'll go with the data turnover ratio. So cash is 25% of 25% of credit sales. Okay. So cash sales plus credit sales is equivalent to cash sales plus credit sales is equivalent to total sales. The total sale 60 lakhs. 60 lakhs. Cash sales 25% of credit sales. That's a clue. That's a clue. That's a clue. So cash sales is equivalent to 25% of credit sale. Credit sale. Cash sales is equal to 25% of credit sales. That is equivalent to 0.25 of credit sales. So cash sales is equal to 0.25 of credit sales. 0.25 of credit sales plus credit sales. Cash is 0.25 credit sales plus credit sales. So one credit sale plus 0.25 credit sale, that is equal to 60 lakhs. So 1.25 credit sales. 1.25 credit sales is equal to 60 lakhs. So credit sales is equivalent to 60 lakhs by 1.25. 60 lakhs by 1.25. How much more? 48 lakhs. 60 lakhs by 1.25, 48 lakhs. 60 lakhs by 1.25, 48 lakhs. 48 lakhs. Credit sales 48 lakhs. Once credit sales is known, then automatically I can go with the data turnover ratio. Data turnover ratio. That's it. Credit sales known? Yes. Then I can go with the data turnover ratio. Right. So data turnover ratio is equal to credit sales by average accounts receivables or average data. Average account receivable by average data. That's it. Here I know credit sales, that is 48 lakhs. Please memorize more. Data turnover ratio is equal to credit sale by average data. What is data turnover ratio? 12 times. What is data turnover ratio? 12 times. The data turnover ratio is equal to 12 times. 12 times. So average data is sorry, no idea. So average data is equivalent to 48 lakhs by 12. 48 lakhs by 12. How much more? 4 lakhs. So average data is equal to 4 lakhs. Average data 4 lakhs. Okay. Next, I need to know total purchase. A total purchase I need to know. But is there any clue available for total purchase? Yes. That is called COGS, cost of goods sold. Cost of goods sold equal to opening stock plus total purchase minus closing stock. That's a clue. We know total cost of goods sold. Opening stock we know. Please check it now. What is the opening stock? What is the opening stock? 6,70,000 opening stock. Please check it out. So 6,70,000 opening stock. We know closing stock 8,30,000. 8,30,000 closing stock we know. Here purchase, cost of goods sold. Cost of goods sold. No? Please check out the cost of goods sold. Cost of goods sold 45 lakhs. Cost of goods sold 45 lakhs. See the line, cost of goods sold 45 lakhs. So cost of goods sold 45 lakhs. So purchase missing. Purchase missing. So 45 lakhs minus 6,70,000 plus 8,30,000, that is equivalent to purchase. Minus 6,70,000 plus 8,30,000, that is equal to purchase. That is equal to purchase. 45 lakhs. 45 lakhs minus 6,70,000 plus 8,30,000. It's going to be 46,60,000. That is equivalent to purchase. Correct? That is equal to purchase. Please check it out. Purchase. 46,60,000 purchase. Please check it out. So purchase equal to 46,60,000. Purchase equal to 46,60,000. Here there are two types of purchase. One is cash purchase. Another one is credit purchase. What is cash purchase? What is cash purchase? Cash purchase equal to 4,60,000. 4,60,000. Cash purchase 4,60,000. Cash purchase 4,60,000. Cash purchase 4,60,000. Please check it out. Cash purchase 4,60,000. Balance credit purchase. So 46,60,000 minus 4,60,000. Now balance 42 lakhs. Credit purchase. Balance 42 lakhs. Credit purchase. So 42 lakhs credit purchase. That's it. Next one. Once credit purchase is known, then automatically we can use creditor turnover ratio. We can use creditor turnover ratio. So creditor turnover ratio, that is equivalent to creditor by, creditor turnover ratio is equal to, credit turnover ratio is equal to credit purchase by average creditors. Average creditors. So credit purchase 42 lakhs. Creditor turnover ratio 10 times. Creditor turnover ratio 10 times. 10 times. Creditor turnover ratio 10 times. What is missing, ma? Average creditors missing. What is missing? Average creditors missing. That's it. So credit purchase by average creditors. So average creditors is equal to, can you adjust 42 lakhs by 10? Bring here, that's it. So 42 lakhs by 10. 42 lakhs by 10 by 10. It's going to be 4,20,000 average creditors. So average creditors is equal to 4,20,000. 4,20,000. That's it. Average creditor 4,20,000. So average creditor. So 4,20,000. Average creditor 4,20,000. That's it. So average creditor is going to be 4,20,000. That's it. Next one. Okay. Average payment period, average collection period. Two more things. Okay. No issues. Two more things. Right. Average payment period to creditor. That is equivalent to creditor turnover ratio. Credit turnover ratio by or you can use this method also. This method also you can use. You can use this one also. So average creditor is equivalent to credit purchase. You can use this one also. Average payment period by 365. You can apply this one also. So 1 year is equal to how many days here? Nothing is given. So let it be start with the 365. 365. Okay. Now what is credit purchase actually? What is credit purchase? Please check it out. Credit purchase 42 lakhs. Please check it 42 lakhs. Credit purchase 42 lakhs. Okay. What is average creditor? 4,20,000. An average payment period is missing. That's it. This is missing. That's it. So can you cross multiply? Average payment period is equal to 4,20,000 into 365. Can you cross multiply? Into 365 by 42 lakhs. By 42 lakhs. That's it. So 4,20,000 into 365 by 40 lakhs. Into 365 by, so 4,20,000 into 365 by 42 lakhs. And it's going to be 36.5. So average payment period, that is equivalent to 36.5 days. So every 36.5 days, I have to make a payment to my creditor on an average. Please memorize 36.5 days. Average payment period to creditor. So average payment period to creditor, how much days? It's going to be 36.5 days. That's it. Next one. Similarly, average collection period. Here also. That's it. So here, average debtor is equal to credit sale into average collection period by 365. What is average debtor? 4 lakhs. What is credit sale? What is credit sales actually? How much credit sale? Credit sale. Please check this credit sale. Okay, credit sale equal to 40 lakhs, no? 40 lakhs. Please check credit sale 40 lakhs. Please check credit sales 48 lakhs. So credit sales is going to be 48 lakhs. Credit sales 48 lakhs into average collection period by 365. That's it. So I want ACP, average collection period. Can you cross multiply? So 4 lakhs, mathematical equation only, into 365 by 48 lakhs. By 48 lakhs. That's it. So 4 lakhs into 365 by 48 lakhs. It's going to be 30 point. Okay, 30.4 days. 30.4 days. That's it. So 30.4 days average collection period. That's it. 30.42 days. 30.42 days average collection period. That's it. That's it. 30.42 days average collection period. Anyway, you use everything. Use everything. That's it. So let's start with the next one. 2016 paper. The following information is given to you as follows: 31/3/2016 for a company. Current ratio is given 2.5. Liquid ratio 1.5. Net fixed asset, that is after depreciation, 1,80,000. Working capital 60,000. Reserve surplus 40,000. Bank overdraft short term 10,000. Assume there is no long term loans or fixed assets. There is no miscellaneous expenses. There is no preliminary expenses. There is no long term loan as well as any incorporated expenses underwritten of no. Nothing is available. Only share capital and reserve surplus only. That's a part of net worth. There is no fixed assets, which means there is no incorporated expenses unwritten off the asset side. So that item is not available. So make your statement the property fund a simple income statement you prepare. That's it. What is property fund? It's nothing but net worth and share capital and R&S, reserve surplus, and match it with fixed asset. If possible, you try to give details of current assets and current liability as detailed as possible. That's it. You try to give as detailed as possible. Current asset you can able to segregate in terms of cash, maybe stock and data asset. Similarly, current liability also possible, bank overdraft and other current liability. You try to segregate as detailed as possible. Okay, that's it. Okay, let's start with one by one. First one, my target always on current ratio and working capital. That's my first priority always. Okay, let's start with current ratio and working capital. So current ratio is equal to current asset by current liability. Working capital is equal to current asset minus current liability. So current ratio here 2.5. Current ratio 2.5. Working capital 60,000. Working capital 60,000. Working capital 60,000. That's it. So working capital is going to be 60,000. So current ratio 2.5. Working capital 60,000. That's it. Okay. So current asset is equivalent to 2.5 into current liability. 2.5 into current liability. Please substitute here. So current asset equal to 2.5 into current liability minus current liability, that is equivalent to 60,000. That is equivalent to 60,000. 2.5 CL minus 1 CL. 1.5 CL. 2.5 CL minus 1 CL. 1.5 CL. 1.5 CL. 1.5 CL. That is equivalent to 60,000. So current liability is equal to 60,000 by 1.5. 60,000 by 1.5. 60,000 by 1.5. It's going to be 40,000. Please check it out. 40,000. So current liability 40,000. Please substitute current liability here. So current asset is equivalent to 2.5 into 40,000. So that is equivalent to 1 lakh. That is equivalent to 1 lakh. So current asset equal to 1 lakh. Current liability 40,000, right? Next, check with liquidity ratio. Liquidity ratio. liquid ratio, that is 1.5. Liquid ratio is equal to liquid asset by current liability, that is equal to 1.5. So current liability 40,000, that is equal to 1.5. Liquid asset equal to 40,000 into 1.5. 1.5, that is equal to 60,000. 60,000. Liquid asset 60,000. By the way, stock we can find. Stock is equal to current asset minus liquid asset. So current asset 1 lakh, liquid asset 60,000. 1 lakh minus 60,000, that is equal to 40,000. Stock 40,000. Stock 40,000. That's it. Okay. Next one. Fixed asset is already given. Reserve surplus given. Bank OD is also given. Everything is given. Please make a statement of proprietor fund. They're asking you. Correct? No? That's it. No issues. But anyway, I'm going to prepare income statement. A statement of proprietor fund. Sorry. Statement of proprietor fund. That is nothing but fixed asset net plus current asset. If possible, segregate the current asset in terms of stock, in terms of debtors, in terms of cash, in terms of cash and bank, if possible. Then fixed asset plus current asset is equivalent to so total asset minus current liability is available, minus current liability. There is no long-term debt. There is no long-term debt. They clearly told you there is no long-term loan. So minus current liability is there. If possible, segregate the current liability in terms of bank overdraft. Number 2, other current liability or creditor. Other current liability or creditor. Other current liability creditor. Balance is equal to proprietor fund or shareholder fund or net worth. Balance is equal to proprietor fund, that is share capital. Number 2, reserves and surplus. Number 2, reserves and surplus. That's it. Number 1, share capital. Number 2, reserves and surplus. Reserves and surplus. That's it. So this is statement of proprietor fund. Statement of proprietor fund. That's it. Let's fill one by one slowly. Okay. What is fixed asset net? 1,80,000. Can you fix 1,80,000 here? Yes. Can you fix 1,80,000 here? Yes. 1,80,000 here. Plus stock. What is stock here? 40,000. Okay. Stock possible. Stock given. Current ratio. Okay, that's it. Okay, apart from stock, is there a possibility of debtors? No, no possibility. Make it sure. The balance is equivalent to balance. What is current asset total? How much my current asset? Current asset is equivalent to 1 lakh of 1 lakh. Current asset 1 lakh. So current asset 1 lakh. But debtors plus cash in bank balance 60,000. That's it. It's 40 plus 60, 1 lakh. 1 lakh. That's it. In your total asset 1 lakh 80 plus 1 lakh, 1 lakh 80 plus 1 lakh is going to be total asset 2 lakh 80. 2 lakh 80 minus current liability. Just we have current liability total. So current liability is going to be 40,000, I think. 40,000. 40,000. So current liability is going to be 40,000. Bank overdraft already given, that is 10,000 short term. Then other current liability 30,000. So that is 40,000. Other current liability 40,000. That's it. Sorry, 10 plus 30, 40. Bank OD. Bank OD. Bank OD. So 2 lakh minus 40,000. That is equivalent to 2 lakh 40,000. 2 lakh 40,000. 2 lakh minus 40, 2 lakh 40. That's it. That's the property fund. What is R and S? 40,000. What is R and S? It's going to be 40,000. So 40,000 R and S. So balance share capital is going to be 2 lakhs. That's it. So this is going to be 2 lakh 40,000 property fund. That's it. So property fund is going to be 2 lakh 40,000. This is called statement of property fund. So 2 lakh 40,000 is going to be property fund. That's it. Now let's go to next one. 2016 paper. The following pyramid is the furniture related to a firm as on a certain date. That's it. So now stock turn ratio is given 6 times. Debtor 2 months sales. Gross profit by sales 20%. So capital 1 lakh. Reserve surplus 20,000. Creditor turnover ratio is given 5 times. Fixed asset turnover ratio, that is sales by fixed asset. Creditor turnover ratio is also given. That is equal to credit purchase by average accounts payables. Fixed asset turnover ratio, that is nothing but sales by fixed asset 5 times. That is okay. Sales by fixed asset 5 times. That is better ratio. That's it. Investment fixed asset or sales 5 times. Sales is better. Closing stock 5,000 more than the opening stock. Closing creditors were equal to the opening value. Both are same. So closing creditors and opening creditors are always equal. That is equal to average creditors. GP is given 60,000. No cash sales, no cash purchase, which means only credit sales and credit purchase. For prepare the balance sheet, if possible, break up as details as possible. That's it. So my first target is always on, always on, always on. GP is there? Yes. GP ratio is there? Yes. My target is always on GP and GP ratio. That is my first target. That's it. That's it. GP by sales, that is equivalent to 20%, 20%, 20%. Sales is equal to GP is equal to 60,000. GP is equal to 60,000. 60,000 by sales, that is equal to 20%. So sales is equal to 60,000 by 20%, by 20%. That's it. So 60,000 by 20%, that is equal to 3 lakhs, 3 lakhs. So sales equal to 3 lakhs. Sales equal to 3 lakhs. Sales equal to 3 lakhs. No cash sales, no cash sales. Therefore, purely credit sales only. That's it. Now, sales going to be 3 lakhs, right? Next one, that is purely credit sale. That is purely credit sale. Because there is no cash sales, but purely credit sale. Purely credit sale. Next, my target is on debtor collection period is given. Debtor collection period. Debtor collection period. This is known as debtor collection period. So how do you come to know debtor collection period? Because here it is given 2 months. 2 months. So debtor collection period is given, that is equal to 2 months. 2 months. So next one, debtor is equivalent to credit sale debtor is equal to credit sale into average collection period in terms of month by by 12 by 12 by 12 in terms of month by 12. That's it. So credit sale is equal to 3 lakhs. Average collection period is going to be 2 months. 2 months. 2 by 12. That's it. It is going to be 50,000. Going to be 50,000. That's it. So debtor is equal to 50,000. Debtor is equal to 50,000. That's it. 1/6. Right. That is also okay. Next, my target is on stock turnover ratio. Stock turnover ratio. So stock turnover ratio is equal to COGS by average stock. Opening stock closing stock difference is given here. Yes. Stock turnover ratio is equal to cost of goods sold by average stock. So cost of goods sold is equal to sale minus GP. Sale minus GP. Now sale is equal to 3 lakhs. Sale equal to 3 lakhs. GP 60,000. GP is 60,000. Gross profit 60,000. Gross profit is 60,000. 3 lakh minus 60,000. 2 lakh 40,000. That is equivalent to COGS. 2 lakh 40,000. COGS. So COGS going to be 2 lakh 40,000. Stock turnover ratio 6 times. 6 times. That's it. So average stock that is equivalent to 2 lakh 40,000 by 6. So 2 lakh 40,000 by 6. It's going to be 40,000 average stock. Average stock. But there is a hint. Closing stock 5,000 more than the opening stock. There is a hint. There is a hint. So closing stock is equivalent to opening stock. Closing stock equal 5,000 more than the opening stock. Opening stock, closing stock 5,000 more than the opening stock. That's a clue. That's a clue. So average stock is equal to opening stock plus closing stock by 2. That is equal to 40,000. That is equal to 40,000. What is closing stock value? Opening stock plus 5,000. So opening stock plus 5,000. Closing stock value opening stock plus 5,000 plus 5,000 by 2 by 2 by 2. That is equivalent to 40,000. Opening stock plus opening stock. 2 opening stock plus 50,000 by 2. That is equivalent to 40,000. So 2 opening stock plus 50,000. That is equivalent to 2 into 40,000. 80,000. 80,000. 50,000 plus 2 into 40,000. 80,000. That's it. So 2 into opening stock is equal to 80 minus 50, 30,000. 80 minus 50, 30,000. So opening stock is equal to 30,000 by 2, that is equal to 15,000. So closing stock is equal to opening stock plus 5,000. Opening stock already 15,000 plus 5,000 extra, which is equivalent to closing stock. Closing stock. Therefore, closing stock is equivalent to 20,000. Closing stock equal to 20,000. That's it. That's it. Opening stock plus 5,000. Closing stock 20,000. That's it. Okay, that also used it. Chapter R&S is given. Okay. Next to my target on credit turnover ratio. For this, I need credit purchase. I need credit purchase. That's it. No problem. Next to my target on credit turnover ratio. So credit turnover ratio is equivalent to credit purchase by average accounts payable. Credit downward ratio 5 times, 5 times, 5 times. Sorry, credit purchase not known. We can find it. We can find it. Cost of goods sold is equal to opening stock plus purchase. Here the purchase is credit purchase only because there is no cash purchase. Credit purchase minus closing stock. Minus closing stock. What is closing stock here? 20,000. What is opening stock? 15,000. The credit purchase question mark. Question mark. What is COGS? What is COGS? 2,40,000. COGS 2,40,000. COGS 2,40,000. COGS 2,40,000. 2,40,000. That's it. So 2,40,000 minus 15,000 plus 20,000. That is equal to credit purchase 2,40,000 plus 5. So credit purchase 2,45,000. Correct? No, please check it out. Correct? No. Credit purchase 2,45,000. Credit purchase. That's it. Once credit purchase is known, automatically we can use credit turnover ratio. Credit turnover ratio we can use 5 times. No, we can use credit turnover ratio 5 times. So okay, credit purchase is known. What is credit purchase? 2,40,000. Okay, substitute here. Credit purchase 2,45,000. 2,45,000. So average accounts payable missing. So average accounts payable is equal to, so 2,45,000 by 5 by 5 by 5. It's going to be 49,000. Going to be 49,000. 49,000. That's it. So average accounts payable is going to be 49,000. Average accounts payable or otherwise known as creditor, simply known as creditor. Average accounts payable or creditor, or creditor, or creditor. Because opening creditors, closing creditors are equal only. No, so no difference, no difference. So both are same only. Both are same only. Average accounts payable or creditors, or closing creditors, both are same only. Both are same only because no difference between opening and closing creditors. Next, my target is on fixed asset turnover ratio, which is 5 times. 5 times. Fixed asset turnover ratio is equal to sales by fixed asset. That is equal to 5 times. Okay. What is sales figure actually? What is sales figure? It's going to be, sales is going to be 3 lakhs. Sales is going to be 3 lakhs. Sales is going to be 3 lakhs. So 3 lakhs by fixed asset, that is equal to 5. Fixed asset is equal to 3 lakhs by 5. That is equal to 60,000 fixed asset. Yes, I use everything. I use everything. That's it. Now, please complete the balance sheet. Please complete the balance sheet. That's it. Please complete the balance sheet. If possible, as breakup as possible. As breakup as possible. That's it. So finally, balance sheet, specific balance sheet or the balance sheet. So liability asset. So capital, R&S, reserve surplus already given. Capital and R&S is already given. So capital going to be 1 lakh. R&S is going to be 20,000. R&S is going to be, so capital going to be 1 lakh. R&S is going to be 20,000. 20,000. Long-term debt, long-term debt, not available, not available. Okay, right? Dash. So current liability, yes. Is there any current liability, ma? No. So far, no. So far, no. Correct, no? So far, no. But only credit are available. Correct, no? Only credit are. Therefore, current liability is equal only credit are. Only credit are. That's it. Only credit are. What is credit are total? 49,000. Only credit are. Only credit are. Next, fixed asset. Fixed asset 60,000. Current asset debtor known, yes. Stock known, yes. Stock debtor, that's it. What is stock actually? I mean closing stock. Closing stock going to be 20,000. Closing stock 20,000. Debtor value, how much is going to be? 50,000, I think. Debtor value 50,000. Almost we did everything. Almost we did everything. Okay, the credit of fixed asset. There is no positive current asset, but current asset consists of stock and debtor only. Anyway, make a total. They won't tally, but you have to make tally. Okay, that is higher actually. 1 lakh plus 20, 1 lakh 20 plus 14, 1 lakh 69,000 here. Here is going to be 1 lakh 69,000. A balance amount 70 plus 60, 130, 130. So 39,000 is the balance figure, correct? No? Balance going to be 39,000. It may be cash, we may assume. We maybe assume it is going to be cash. And please assume it's going to be cash. Please assume it's going to be cash. That's it. That's a breakup. That's a breakup. That's a breakup. Please check it out. All data we used. Data stock, credit card, yes. Fixed asset, yes, everything. Fixed asset 60,000, right? No, that's it. So 1 lakh 69, 70 plus 60, 1 lakh 30, 13 is missing. Missing figure is going to be, let it be cash. Let it be cash. That's it. Cash. That's it. That's it. So all details we applied. That's it. Okay.